Buying a home is one of the biggest financial decisions you'll ever make, but one mistake could cost you thousands of dollars or even cost you the home itself. In this video, I'll walk you through the most common home buying mistakes and most importantly, tell you how you can avoid them. The first mistake I see is searching for homes before getting pre-approved. This is a mistake because you don't know how much you can afford. You can do online mortgage calculators, which I think they're a great tool so you get a decent idea of how much you could afford, but you really won't know what you can afford until you talk to a lender and show them all the information that they're going to want to see, like bank statements, tax returns, things like that. Real estate can be very fast moving, so even though a pre-approval may only take a day or two, by the time you get that pre-approval letter, the home that you fell in love with may not be on the market anymore. It's important to have a pre-approval letter because sellers are less likely to accept your offer if you aren't pre-approved. I've had some clients in the past who've told me, "Oh, I can get a pre-approval in an afternoon. It doesn't take that long at all." And I agree, a lot of people can get pre-approvals pretty quickly. However, I have seen some instances where maybe the buyer didn't have all the paperwork that they needed, or it turns out that their file is a little bit more complicated and it's going to take the lender some time to figure out exactly how much they can pre-approve you for. Another major mistake that I see homebuyers making is only focusing on the mortgage payment. You don't want to forget about property taxes, homeowners insurance, and HOA fees if it's applicable, maintenance, repair costs, utility costs, and all the other costs that come with owning a home. How you avoid this is by budgeting. You want to factor in all of your monthly homeownership costs, not just the mortgage. You can get an estimate of your property taxes and your insurance before making an offer. Some counties and municipalities have a property tax estimator that you can use online, or you can call your property tax office to get an estimate on how much your property taxes might be. For insurance, one of the things I recommend homebuyers doing is already picking out a homeowner's insurance agent. They can be a really good resource because they can tell you how much insurance might cost for a home, and when you get an accepted offer on a home and do an inspection, you can show that inspection report to the insurance agent and they can tell you if there's going to be any issues that might come up where that home cannot be insured as is. If you'd like some free resources like an affordability calculator, check out my website workwithdang.com. There's a free homebuyers course and I can help you find a realtor in your area. As far as maintenance costs and repairs, it's recommended to save 1 to 3% of the home's cost each year for maintenance and repairs. Another thing to consider is property taxes, homeowners insurance, and HOA fees can rise. Currently, there are some areas where I'm seeing homeowners insurance and property tax doubling and even tripling. Now, of course, this is hard to avoid and you can't always prepare for it. However, the way that I would prepare for this is when I'm doing my budget, I want to make sure that I'm not at my max amount that I can afford. I want to give myself plenty of wiggle room just in case anything comes up. Another mistake is spending all of your savings on your down payment. A lot of buyers assume that they need a 20% down payment to buy a home. 20% isn't always the most realistic for everyone to save. Now, there is an advantage of putting down 20% or more on the home, which is you will not have to pay mortgage insurance or PMI. This is assuming that you're getting a conventional loan, but in a lot of cases, you don't need 20% down. When you're saving for the down payment, you do need to realize that there are some other costs involved in buying a home, like closing costs, which could be anywhere from 2 to 8% of the loan amount. Of course, there are moving expenses, and you want some money for emergency repairs. I can't count how many times I've gotten a call from a new homeowner that within a week or two, the AC went out or something like that. Also, you'll want money to pay for the inspection, appraisal, home insurance, and other fees that might come up before you close. Sometimes you'll need to pay the home insurance before the lender will close on the loan. One way that you can avoid going through all of your savings is to consider low down payment loan options. There are FHA loans, which you only need 3.5% down if your credit score is 580 or more. There are also USDA and VA loans that require 0% down. There are some limitations within the USDA and VA loans. For instance, for the VA loan, you have to be a veteran or active service member to apply for that loan. For the USDA, there are some income requirements and the home has to be in a USDA-Approved area, which typically means that it's in a rural or suburban area. Then there are conventional loans. Gone are the days of having to have that 20% down payment for a conventional loan. Even though in a perfect world, if you're able to save for a 20% down payment, that's a very good thing. Something to keep in mind is with these lower down payment loans, you will have less equity in the property. So what that means is if something were to come up and you had to sell your home quickly, if you didn't have a lot of equity in the home, when you go to sell it and you pay all the seller closing costs and all that kind of stuff, you may not have a lot of money left over for your next move. If you're going to go with one of these lower down payment options, I do recommend that you live in the home for at least 5 years. And honestly, I think 5 years could be cutting it depending on where you're going to buy a home and what's happening in the real estate market. If things are slow and values are going down a little bit, then you probably want to be able to commit to about 10 years of living in that home before it's profitable to sell. Something that's recommended is to have at least 3 to 6 months of emergency savings after closing. Now, that is a suggestion in a perfect world. Again, nowadays it's hard enough to be able to save for a down payment, closing costs, and all that kind of stuff. And then on top of that, having 3 to 6 months of emergency savings is a lot. However, what I would recommend is after you buy the home, have a pretty aggressive plan to start saving money so you can have that emergency fund just in case. There are also down payment assistance programs. There are thousands of these and they vary by city, county, and state. So your best course of action is to talk to your lender or real estate agent and they can probably suggest some down payment assistance programs that might work for you. Some of these act like loans that you might have to repay at some point, and some are forgivable loans. The next mistake is waiving the home inspection. This is common in areas where there's a lot of competition. To make your offer stand out and be stronger, some people will elect to waive the home inspection. I understand why people do this and why realtors suggest people do this. However, I think this can be a very bad idea. And the reason is, even if the home looks like it's in great condition, it's clean, it's perfect for you and your family, there can be hidden structural, electrical, or plumbing issues. And that's only the start. It's a really good idea to have an inspection to make sure that this is a good investment. And really, what you have to think about at the end of the day, even if you do a thorough inspection on the property, there are some things that the inspector may not see. There are things behind the wall that could be issues that they don't know about. And honestly, these inspectors are human and they will miss things from time to time. Once you own the home, it's your responsibility. For the most part, there isn't a lot of recourse if you buy the home and it's defective. To be clear, there are some exceptions to that rule, but it can be pretty hard to prove sometimes and receive compensation for it. A way you can avoid this mistake is always hiring a professional home inspector. But again, if the market is competitive, it can be hard to be able to compete if you have a long home inspection timeframe. So as an alternative, you could choose a shorter inspection window instead of waiving it completely. So let's say in your area the inspection period is typically 7 days. You could do maybe 3 days. You just want to make sure that as soon as you get that offer out, you want to start to talk to some home inspectors already. So essentially, as soon as you go under contract, you want to have an inspector come out within about a day if you have a short inspection period. This isn't something that I love. However, in a competitive market, sometimes that's what you have to do to be able to compete. Another thing that I've seen people do is if you love the home, what you can do is find out when the sellers are going to decide on what offer they're going to choose. Then, while the home is still on the market, with the seller's permission, you could get a home inspection. Then you'll have a really good idea of what's going on with the home and what would be a fair offer. Now, this isn't something that I would suggest people do all the time because this obviously can get expensive. You can pay for the home inspection and not have your offer accepted. A home inspection can be anywhere from $300 to $500 and maybe more, depending on the size of the home and features in it and what kind of inspections you end up asking for. But if you already have the home inspected, then you could waive the inspection period because you already inspected the home. Another mistake is making large purchases or taking on new debt before closing. Lenders check your credit, debt to income ratio, and bank accounts before closing. A new car loan, furniture purchase, or a credit card increase can delay or even cancel your loan approval. Unfortunately, I've heard of this happening to people. Some people just don't realize that you're not supposed to make these big purchases purchases when you're under contract trying to buy a home. Sometimes lenders and real estate agents assume that people know that this is common knowledge. However, it's not always common knowledge. Also, if you're planning on closing an account, for instance, maybe you're going to pay off a car payment, this can also temporarily lower your credit score. So my recommendation to you is before you make any other big purchases or do anything that could affect your financial income or your financial well-being, whether it's positive or negative, reach out to your lender first. The last mistake I see buyers making is not shopping around for the right loan or lender. Sometimes people will only talk to one lender and they won't compare interest rates in terms of the loan. I see this a lot of times when people are home shopping before they even have a pre-approval. They find a home that they like and need to get the pre-approval real quick, and they only talk to one lender. You also want to explore multiple loan options because there might be a better fit for your situation. What I recommend you do is talk to at least 3 lenders. You can ask about loan programs that fit your situation, like low down payment, first-time homebuyer programs, things like that. You want to compare interest rates, lender fees, and other loan terms before committing. One thing that I would also recommend is to look up how your credit score will be affected by hard inquiries on your credit. There's a way that you can get the credit pulls to only count for one hard inquiry. The rules kind of change a little bit, so I don't want to say exactly what they are, so just look that up so you know what the rules currently are. Please like, comment, and subscribe if you've gotten any value from this video. It helps me out a lot.